All right, guys. In here, we're gonna talk about key levels, and I'm gonna talk in here a little bit how you guys gonna be able to put them in the chart and what are actual key levels. So let's go back here to our little slide that we got here, and I forgot where's the slide. Oh, right here, of course. So we got our key levels right here. Got this small PDF here. So what are the key levels? The key levels are pretty much where levels that you're gonna mark on your chart that it gonna let you know that there is probably a retracement, there is probably a discount level. Pretty much there are gonna be lines that you're gonna put on your charts. Especially myself, I don't like to put them because I kind of know where are those key levels myself because I memorized for my 4 or 5 years trading the same pair. So I like to having a clean chart known as naked chart. But for you guys that are starting to understand what are key levels, here key levels are price area where market reacts support, resistance, or previously high and lows. They show where institutional traders or algorithms might enter or exit trades. Marking them help you identify zones of liquidity, reversal, or continuation setups. I think of them as a pretty much as the DNA of the structure that, for example, if you this is not here yet, right? The market is over here, and you anticipating the market is gonna go up, right? So you want to know how much up the market is willing to go, right? So now we're gonna talk about the different type of key levels that we can find. So first of all, we're gonna start with the most basic one. Is known as psychology level, and those are levels where the price looks like this, like 2000. The gold hit 2000. The whole hit $4,000. And the gold be consolidating for between 2065 to 2095 for a whole week and a half, and finally, the gold hit 2100. So at the minute they hit 100, the market is gonna react. Is he gonna push up or is gonna push down? But the market is gonna do something, you know. So those are psychology level. So if we come here on the chart, you hear 4000 over here. With the 4000 level, you see the market come hit it once, two, three, four, five. So this is a level, a really strong level that at this at this level is known as a psychology level, but we have more of um this level. It's more of not only a psychology level. It's a discount level of zero point 0.5 Fibonacci here, and it's a swap liquid level that we gotta go into those ones as well. So as now this one right here is a psychology level. If we go back down at 50 here, this is another psychology level. You can see here the market react. If you go more, you can see here, the market stay here because why? Because it's at 3950, which is at psychology level. 3900, you know 4000. Those are psychology levels. So another levels that are good, it's imbalance or feel fair value gap zones. You can see here this is a fair value gap zone. The market came down and hit it. So a lot of traders, if the market pushed up like that, a lot of traders, damn, I missed the trade. Let me wait for a retracement. And they see this fair value gap in here. Remember, fair value gap is three candles. When the one in the middle push up really a lot, it doesn't create like an overlap like this one. This one has overlap, so the market push up with balance. In here is a little imbalance, the market trends to come down, fill this little gap in here to then do the continuation. So when you see the market is going on, and you see the market is up here, right? And you see there's a fair value gap, you might want to mark this level. If you see the market start creating a structure to come down to this level and create this inverse fair value gap that you guys can see here a little bit, it's not much, but at least this one, then you know that there's a continuation that you might want to hop in the trade. So this level here is a fair value gap that if you come to the chart, you can see one in here. You can see that This is our fair value gap here. That if you market, the market push up right here. Damn, I missed the trade. Let me mark it. I'll mark it. In this case, you can see here how the market went and hit this level. So this is a fair value gap where imbalance was made. Imbalance was made in here too as well. Kind of the same. That's what the market tried to come up here, but the sellers pushed it down. So that's fair value gaps and Fibonacci confluences. You can see this is zero point 0.5 Fibonacci, which is, you guys know, in the previous videos I talk about zero point 0.5 Fibonacci as a discount level, as a level where a lot of traders step in to help in the trade. So um, we go now to Fibonacci key level trend. So if you know a big push, like I explained, the Fibonacci level, like here we got a big push in here, or especially here, this sell here, this strong sell here, a market, the market to come all the way over here to this previous level with the market hit. So if you start going to the Fibonacci level, you start marking uh this level of zero point 0.2. You can see the market stop here, kind of stop here, stop here. That's a level that you can mark up. You can mark also this level, and obviously the zero point 0.5 Fibonacci level, you obviously got to mark it. Same with the zero point 0.1. So if you put this Fibonacci going down, so you have to mark this level, because you might want to take your profits out here. We sent a trade today to our Telegram chute where we started at 39.22, or TP1 at 39.12. I'm sorry, 40.12, and the TP2 40.07. Views around here. I aim for that zero point 0.5, 0 points, a little more than that ish, because I sometimes it's not perfect, so I didn't want to, like, just be exactly with it, but it just moved the market exactly how we wanted it. So we mark these levels, zero point Fibonacci and 1 Fibonacci. Those are really strong key levels that you guys can mark. So you guys can see here, I mark it for you guys. You guys can mark those Fibonacci levels. In all those levels, at the end of the day, they are gonna give you a confluence. For example, zero point 0.5 Fibonacci, boom, zero point 0.5 Fibonacci in here. That 0 point Fibonacci is the same level that is swap liquidity. All this level, this is an equal high swap liquidity. You can see this is another equal high swap liquidity. The market didn't push down, but from here 98 all the way to 92, that's all the way. For example, here, if we were to send it all the way here, that's a whole TP1. That's like $2,400 if you put two contracts. A lot of money just in this, because you mark that level. So fair value gap, uh, zero point 0.5 Fibonacci level, and at the same time swap liquidity gap level. So you got three different congruences for, that's a strong level. This is the last one. I'm sorry. I think I didn't show you guys, but swap liquidity level. Swap liquidity. It's I I haven't get to you guys explaining what is swap liquidity yet, but this is a small example here. How do you gonna be use what swap liquidity is important, and mark those levels as well. You know, they usually place at previous high or lows on tested zones that still hold receipt orders. So, like I say, a lot of traders, oh, market starts selling, they go put the stop loss right here. So the market usually comes back up, try and take those people out to then push down for where he was gonna go. So that's, the market went here, market start going down, people play sales, 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 sales. There's a start. This become as a zone of swap liquidity grab. The market is gonna come up here, take out all these orders are here. A lot of people put stop loss are here, 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 and even here. Market comes up, take down. So boom, this is our swap liquidity lever. So in here, we want sometimes place a sell, or even to place a buy. Depends how the market reacts. So this is explain to you guys how you're gonna mark key levels. You come here, for example, this is a tool in your top set account. For example, you can come here, you can mark horizontal. Let me actually take this one off, right? Let me take this one off so I can mark you guys from zero really quick. You guys can put it in practice with me. So this is the trade that we're saying. Let me take this Fibonacci out. Boom. Let's see. This is me this morning doing a small analysis, right? So I was like, I think the market is gonna run out of buyers out here. The market went up here, followed buyers, went up here, swap liquidity, this followed buyers, and there's a fair value gap here a little bit. Let me hit this. So I was over here. Let me sell here. So I put my Fibonacci. You put your Fibonacci over here. You put a Fibonacci all the way to previously low here to the session before. So we mark level, this level 0.5. All right. Oh, this level mark kind of with these, and up here, not up here, up here. So let me fix my Fibonacci. So you start moving your Fibonacci, how you think it marks with all the levels. So 0.5, okay, perfect. Oh, awesome. So I aim for that trade, 0.5 Fibonacci to these levels. If the market is gonna push up here, we might want to clear this imbalance here as well. So there is a lot of congruences. Come here. All right, let me mark this level because it's around Fibonacci and swap liquidities. So you mark that level, and I mark my swap liquidities levels with a red, and also all the levels like fair value gaps level. All the levels are marked with different colors. So guys, this is pretty much it. How you can use key levels and how you can mark your chart. And the main reason for this is because you want to stay away from emotions. So if you already knew the market was gonna come to 0.5, right, and you place your trade at 22, and the market shoot down crazy, right, it didn't take you out, for example, for almost nothing. You have your, for example, your TP here, and you can see the market going back up here. I don't get out of the trade. I move my trade to break even here to 600, 500. I know I was here like $3,000, and I go like, wow, I did lose all that money, but I stay positive. I hope the market is gonna push it down. So that's exactly what happened during stock market open. This is stock market. Move it to 930, 930. Move it up here. You stay positive. The market push it down. Moment to push it down. As long as they hit, all these levels, you're even 0.1 Fibonacci, 1.0 Fibonacci, the market start retracing with a lot of volume, because that's exactly where a lot of people probably had orders here for a buy, and push the market back up. And the market come back, hit again 0.5 Fibonacci, and what it does, the sellers step in again and say, no, 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 I'm taking over the market. And the market is about to close in 40 minutes now, a whole bearish. So guys, this is how you put key levels, and I hope this is helpful for you guys.